Ray says, hey, Money Guy team. My employer offers a variety of funds in their Fidelity 401k plan, and I was wondering what's the highest gross expense ratio you'd be willing to have? My options range from 0.3% to 0.1%. We get this question. I'm sorry, 0.3% to 1%. I said that wrong. We get this question all the time. Hey, because you hear us talk all the time. We love index funds. We love low cost. It's been a race to the bottom amongst a bunch of the big index fund providers. And so a lot of people, because they know that and they believe that, they start to get anxiety when they see anything that's not a bottom of the barrel expense ratio. So is the correct answer you don't ever pay a higher expense ratio? Or if you do, how do you know when and why, and does it make sense to?
Well, I mean, it's nuanced. I mean, because let's talk about different asset classes just as an example. Large cap. That's all your top 500 companies in the United States, the S&P 500. I'm going to be pretty upset if I'm paying 1% for that, because I know that there's index funds that charge me. I mean, Fidelity has a 0 fund, but a lot of funds, it's not hard to get 0.01, 0.02, which is still pretty close to free.
Yep.
So that's Ray. I ought to look at each asset class and think about, what am I getting for this? Large cap should be practically in the basement to 0. If you're paying a high fee on that, I would start questioning that. Is there a rate of return that's exceeding what the benchmark is doing to justify this? And the research from Spiva shows that over the long term, 80+% of managers don't
underperform.
They underperform. So that was why I try to beat the market when you can be the market, and just try to maximize the lowest cost option as possible. Now, there are the cases like we're in this weird interest rate environment with bonds. And look, I like bond index funds too, but I noticed we did our attribution analysis for our clients recently, and it was interesting to me that all the managers smoked the indexes. And that's because that manager was obviously playing around with the inverted yield curve, the choice of the different types of papers and other things that they were buying, because we're in a very inefficient marketplace with the crazy interest rates and all the other risks that are going on right now. So once again, I looked at the asset class and I said, okay, how does this compare to the indice? We're in this moment of weirdness that it looks like the manager is actually overperforming, and to the point that it well beyond what the cost is. That I'm going to be okay with paying a little bit extra on that.
Yep.
And I think you have to look at that on every asset class that you're doing. I mean, definitely the big ones, because you want to make sure that you got some diversification in there, depending on what age you are and what your risk profile is and what your goals are. So that's the way I look at it. And then, Ray, I'll bring this back to it, because you said you have a Fidelity. Now, I'm surprised because you said you have a Fidelity 401k, but your lowest cost is 0.3.
That was very surprising.
That was because usually when I see Fortune 500 Fidelity 401ks, they are practically free on the internal expenses. And a lot of them offer the index target retirement fund, where those index target retirement funds with Fidelity, I know, are less than 10 basis points. So it's like 0.08, 0.07, depending on which one that you're looking at. So there are options even there. But I would just say, if I'm going to pay a fee, what am I getting for that fee, and how does that fit to the asset class that I'm investing in?
And then the other thing I would do is I would think about your total portfolio. So when we do portfolio analysis, we look at the total portfolio's internal operating expense. You just take your weighting times the internal expense and you figure that out, or you have a software that can help you do that. And then, just like Brian says, you sort of granularly work through each individual asset class and then each fund in that asset class. Now, we are of the opinion that a lot more of your return is driven by your asset allocation than the specific security selection. So understand, focus on the big things that matter and don't get lost in the minutia. But I do think there's probably a little bit of room where you could improve your plan. You said it great, Brian. Make sure you know what you're paying for and you're getting value out of that.